Welcome to everyone. I'm Zoe, Events Manager at Brand Finance. Thank you for joining our webinar today as Brand Finance has partnered up with IVSC to launch the Global Intangible Finance Tracker, or GIFT 2021, where we will be reflecting on 25 years of intangible asset value and the future of financial reporting. We're pleased to be joined by over 300 people from around the world today. I will shortly be handing over to David Haig, CEO of Brand Finance, who will be opening today's event. Just a very quick note on housekeeping. The format of this 90-minute long webinar today will follow a presentation of the GIFT 2021 findings, followed by 3 10-minute presentations by our guest panelists. There will then be the opportunity to participate in a moderated Q&A session. So please do submit your questions to our presenters through the Q&A facility in your Zoom platform. And to confirm, we will be sharing a recording of the webinar after today's session. And we also kindly request that on leaving the webinar, you fill out a brief survey providing feedback that will be helpful to develop our future webinars. And finally, I'd like to encourage you all to engage with us on social media, LinkedIn, Facebook, Twitter, using our hashtag BFGIFT2021. And now I'm very pleased to hand over to David, who will be introducing today's session and our panelists. Thanks, David.
Thank you, Zoe, and thank you for everyone who's signed up and is coming to the event. I ought to begin by saying that we've now been in business for 25 years, and right from day one, Brand Finance has actually pursued an argument about intangible finance reporting as a way of highlighting the importance of brands in particular, but all intangibles. So we've been talking about it for a very long time. One thing which I think is relevant is that when we launched it, we actually referred to it as the Global Intangible Tracker, GIT for short. Nowadays, I'm partially retired down here in Cornwall, and I'm in a gig rowing club where we are referred to as the old GITs. So you can actually understand why we decided to rebrand ourselves, and we decided to call it GIFT. So it's now called the Global Intangible Finance Tracker and has been for about the last 20 years. And the point is, we have actually been tracking this information for a very long time. I've actually seen 1 or 2 studies that are US specific and look at S&P 500. Ocean Tome, I think, produces one, and 1 or 2 other people do as well. But that looks very specifically at the most valuable American companies only. The unique thing about the GIFT study that we produce is that we look at all stock markets throughout the world, and we look at all quoted companies. So we add them all together, and it comes to something like 60,000 companies. And we look at the level of intangible value that's implicit in those companies. And my colleague Annie will talk us through that in a moment. But the fact is that for many years now, it has hovered at or above 50% of total value of all companies worldwide, which I think is almost more surprising than the statistic that 80 to 90% of the top American companies are intangible. So this is a very big issue, and it is not just for pharma companies and for tech companies, it's for all companies in all stock markets. I'm very pleased to say that we this year have been joined by the IVSC, who are helping us in partnership to do this. And we've got Kevin Prahl, who's the technical director here, giving his point of view. I suppose I ought to stress that everything we say is not necessarily agreed by IVSC. We sometimes might take a slightly more extreme view than the IVSC, but we can get into that debate later on. And secondly, I'm very pleased that Tom Scott from the board of the IASB is here. The IASB is currently in the process of reviewing the future of intangible reporting and goodwill, and I'm not sure there's actually a date for determining that, but it's a very, very interesting issue which will make a big difference to a lot of people, both in clients and certainly to Brand Finance and similar consultancies when we find out what the answer is. Annie has actually been following this for us for the last 2 or 3 years and has got her feet well into the space, and I'm looking forward to what she has to say. We're going to monitor any questions that come up during the session, and we will try and feed back as many questions as we can in the 30 minutes at the end. So if you've got questions, please put them on the chat function. We will try and answer them. And before I pass on, the only thing that I would end by saying is that I've heard many arguments about financial reporting and how and why we should retain the historical cost convention or the historical cost convention with adaptations. The real question is, what do stakeholders want? What do shareholders want? What do people really want financial reporting to say about the companies that they are part of or invested in. Our fundamental view is they want a lot more information than they currently have, and that there are many excuses as to why it's not given, and many are not really satisfactory. And I hope today we will have a very good debate about that subject, particularly in the Q&A. And with that, I will hand to Annie. Over to you.
Thank you, David. Thank you, everyone, for joining us today. So I'm going to be talking through the results, the top-line results from this year's Global Intangible Finance Tracker study. So 25 years ago, in 1996, when Brand Finance was founded, the level of intangible asset disclosure was just $300 billion. Today, that stands at $15 trillion. And over the past 25 years, there's been two key factors contributing to that major growth. So one thing is obviously the global fabric of business has changed. We're increasingly interconnected across the world thanks to the internet, and increasingly using digital technology. And there's more importance of partnerships and relationships. And all of these things together contribute to the fact that intangibles are increasingly important for a successful international business. The second factor that's contributed to this growth is that the valuation standards about what can and can't be disclosed have changed. So in the late 90s and early 2000s, there were a series of valuation standards introduced by the US, the UK, and the International Accounting Standards Board. These together provide guidance to businesses on how to account for the intangible assets, primarily those that they've acquired through business combinations. And those standards really set the scene for the growth that has then been seen since then, up until now, in terms of the disclosed intangible assets. There's also been a series of initiatives launched to help guide valuation practitioners in how to make those valuations of intangible assets reliable. So that includes standards released by the International Valuation Standards Council, the IVSC, which provides guidance on valuing different asset classes, including intangible assets. In 2010, a technical committee chaired by David Haig was launched the first international standard on brand valuation, ISO 10668, which provides the different methodologies and provides guidance to valuation practitioners on how to value brands and how to make it reliable so that they are up to the standard that's required for financial reporting. Similarly, in 2019, a similar standard was brought out that complements ISO 10668 called ISO 20671, and that's all about how do you reliably measure the strength of a brand. In the meantime, the OECD has turned their sights onto intangibles as well, providing guidance on transfer pricing for intangibles due to the major tax implications that can be brought by international businesses with significant intangible assets. And then just last year, the IASB launched a review into goodwill and impairment, as David was talking about. And before we move on, we're going to launch the first poll that we have. And Zoe, if you could launch that for us. We have a couple of polls throughout this webinar where we'd like to get your feedback and get your opinion on a few key topics. So the first poll is, how strong do you all think the quality of global intangible asset disclosure is today? And we'll give you about a minute to respond to this. So thank you to everyone who's voted so far. Just to repeat, that question is, how strong do you think the quality is of global intangible asset disclosure today? Okay, I think we can close that poll now. Thank you, Zoe. Share the results. So the majority of you said that it's mixed, somewhat strong and somewhat weak. And then 35% of you think that it's weak, and only 5% of people think it's strong. So I'd agree that it's mixed. And that's part of the problem. Some intangible asset disclosure is very good and very accurate, and some is not so strong and not so reflective of reality. And that's what provides a big issue for investors in interpreting intangible assets. So of this intangible asset value at 15 trillion today, the large majority is goodwill. So when we're doing our Global Intangible Finance Tracker study, we divide disclosed intangibles into two different classes. We look at something called goodwill, so disclosed goodwill, and then the remainder is net disclosed intangibles, which is essentially the intangibles that have been recognized and are specifically associated with certain things. So it could be technology, customer relationships, contracts, and that's how they're disclosed in annual reports. We think that those specific intangibles which are disclosed are much more useful to investors because there's a lot more substance about them. Goodwill, on the other hand, is essentially goodwill comes from when an acquisition is made. It's the price paid above and beyond the value of identified assets. So it's sometimes people think it's the amount that's been overpaid for an acquisition. In reality, what it's supposed to represent is the additional synergies that are going to be achieved through an acquisition. But in general, investors find this sort of amorphous asset quite hard to grasp and quite hard to know what to interpret from it. And so often it's ignored in financial reports. But given that that stands at 9 trillion, that's a really significant value that investors are essentially ignoring. And so it'll be interesting to hear from Tom about what the IASB are thinking about this topic at the moment. This high value is one of the contributing factors of why they've revisited goodwill, and they're considering how they can change it, the regulations around it, and make it more interpretable for investors. So looking at disclosed intangibles doesn't give us the whole picture. So as I mentioned before, the majority of disclosed intangibles are those which have been acquired because that's what's allowed to be disclosed. When we look at the total intangible value, there's an additional 59 trillion estimated value of intangible assets, which are essentially homegrown. So those are things like the Amazon brand that Amazon can't put on their balance sheet, but is definitely something that is value and is recognized as value by investors. When we accommodate this undisclosed intangible value, which we estimate through our study, we can see that today, intangible value in total represents over half of total asset value. It's been a bit of a bumpy road in the past 25 years, but that started at 43% 25 years ago. But as David alluded to at the beginning, some markets are far more intangible than others. And of course, the most valuable companies in the world are going to have more valuable intangible assets than others. In the US, Denmark, and Ireland, intangible assets represent over 3/4 of total asset value of the companies registered there. In Greece and Russia, some years over the past 25 years, their intangible asset value has been negative. And that's basically because their stock market value, according to investors and how much investors are valuing those companies, is lower than the balance sheet value of their assets. So that comes from low investor appetite for investing in certain stocks, but also from misunderstanding of the true value of businesses, either by the management preparing the accounts or by investors who are struggling to get the information they need about those companies. When we look at the composition of total global intangible value, so that $74 trillion, the majority of that is represented by both the internet and the tech sectors, both sectors which rely really heavily on intangible assets, being both technology, but also brand and relationships and all the other intangible assets that they rely on for their businesses to be more competitive and more successful. They together are representing the most in terms of the absolute value share of global intangible value. And that's partially driven by the largest companies in the world being internet and tech brands. And so they represent a large share of global value in total. When we control for the size of the industry, we can see that the most intangible sectors today are cosmetics, a sector which relies really heavily on trust, on branding, and on formulas and their own technology, and aerospace. And aerospace has seen a large jump in a gradual rise in their intangible share of their business value over the past 25 years. And that's really reflective of the new types of technology that aerospace and defense companies are utilizing, and they're moving away from just using physical technology to using software and AI and lots of other different types of intangible assets in their in their operations. 25 years ago, the most intangible sectors were drinks and commercial services. And they're still quite intangible today, but they've been overtaken by cosmetics and aerospace and defense. So when we were comparing before the US versus Russia, they're both very different countries for various different reasons, but national industrial composition makes a big impact on how intangible a country is. So the US, the biggest sector, both in terms of total asset value, but also in terms of intangible value, is internet and software. And that's really driven by Silicon Valley and all of the large companies there. Russia, on the other hand, its biggest sector is oil and gas, followed by mining, both of which are quite heavy industry, tangible, reliant industries. So it's unsurprising that Russia is not as intangible as other countries when the majority of their listed businesses and that value are in quite heavy industry, traditional industries. So it's important for investors to be able to understand the relative size of different industries in a country when they're considering investing. But also it's important for investors to understand how much intangible value there is in different industries. From a government level, it's important also to understand this because it can help in guiding budget and resource allocation to developing different industries for the future. So the US has clearly supported and being an incubator of tech companies. And that's delivered returns in terms of how intangible the US is and how much international capital it's able to attract. You think that disclosed intangible is a good indicator of how intangible companies are in general, but it's not the case. When we compare disclosed intangibles as a proportion of enterprise value to undisclosed intangibles as a proportion of enterprise value, there's very little correlation between those two things. So while Belgium has very high disclosed intangibles, it doesn't necessarily have that much more undisclosed intangible value. And the reason that Belgium is so high is pretty much driven by AB InBev and their acquisition and all of the goodwill recognized on that acquisition of SABMiller. So for investors, it's really hard to understand where intangible value is and what that intangible value is, because they can look at the disclosed intangibles, but that doesn't really give a guide of the total intangibles because homegrown intangibles just can't be disclosed on balance sheets. So there's a bit of an odd dichotomy where acquired intangibles can be talked about, disclosed in balance sheets, and investors can see them, whereas the often more valuable homegrown intangibles aren't available for investors. And so as a result of that, investors often disregard intangibles altogether because they don't think that they're providing much information about the value of that stock. Looking historically, again, at the total value of intangibles, including those that are disclosed and our estimate of undisclosed intangible value, they've grown by approximately 11% a year. Particularly in the past 10 years, that's looked a bit like exponential growth. And if we were to extrapolate that into the future, that could mean that by 2050, intangible value stands at over $1 quadrillion. And I had to Google what a quadrillion was, and I'm sure I'm not alone there. But just to give some context, that is equivalent to about 69,000 of what I'm told is the most expensive car in the world, a Bugatti, 6,000 of Jeff Bezos, 650 apples, not the eating kind, and about 60 times the US GDP. So this is a really significant amount of value, and it's growing. It's grown a lot over the past 25 years. It's set to probably keep growing in the future as we're all working from home, using technology, increasingly relying on relationships with people for the success of businesses. We're seeing partnerships being really important as businesses moving forward. And it's really important that both business management and also investors are able to readily understand this value. With that, I'm going to hand over to Kevin, who's going to talk us through where the IVSC are on this topic. Thanks very much. Over to you, Kevin.
Hey, Annie, thank you. Just want to confirm that you can hear me okay. I'm having issues with my camera here, so Thanks for the nod. Hello, everyone, and do apologize for not being on camera. Kevin Prahl, I'm the Technical Director for Business Valuation and Tangible Assets at the IVSC. And I'm just going to tee up here for about 10 minutes, a work stream that we've just recently kicked off. And if you go to the next slide, we've kicked off this 3-part article series on internally generated intangibles. The article series is titled Time to Get Tangible About Intangible Assets. Really in this article series, what we're doing is we're examining the need, which we heard Annie just talk about to a great extent, as well as opportunities for kind of enhancing the current frameworks and standards around accounting for intangible assets. If you go to the next slide, thanks. So just really fast on kind of a little background and perspective from the IVSC. So our mission, first and foremost, is to develop and propagate a global set of valuation standards. But in addition to that, in addition to the standard setting component, we also explore emerging issues, which we believe are really systematic kind of issues to both our valuation, like direct stakeholders, but also kind of the broader kind of capital markets and those stakeholders. So this has been a big issue for a very long time. As David pointed out, brand finance has been talking about it for decades now. But it really seems like there's kind of momentum behind this at the current time. Kind of, we'll talk a little bit about what the pandemic has done to kind of even further exacerbate this issue. But we've really identified this misalignment of reporting standards with how value is created in kind of modern business models is really kind of the key issue. So what we're doing is a research project and related article series to kind of help move this process forward. One thing we always like to highlight when doing these papers is just the perspective that our board members have that is a little bit unique. It's not just a valuation perspective, but the board members as valuation people, we are users of financial statements, right? If you think of valuing any company or any asset, you're always using a capital asset pricing model, using market approaches, right? And the quality of that information that you're getting on those comparable companies and on the market is very critical to how we go about valuing a closely held business or a closely held asset. In addition to that, we also do a lot of measurement of fair value, which then goes into financial statements. So we're very familiar and very much a part of the preparer ecosystem. And then lastly, as many of us work our day jobs, if you will, are with public accounting firms, we also get involved on the review side, the audit and assurance side of things as well. So we really have a pretty good perspective of kind of this entire ecosystem. So we're really going to focus on this first article, which we published earlier this week on that need. Why does this matter? What issues does it cause? First and foremost is that it ignores the matching principle. A lot of people like to talk about this, and I will also from a balance sheet perspective. The balance sheet is where this issue manifests itself, but the real issue is on the income statement. And it's about a lot of things that are getting expensed that in modern kind of value creation models are much better characterized as investments that are expected to generate an economic benefit at some point in the future. And as we go longer and longer in time, it just seems like those investments have longer tails to them with this shift towards intangible assets. The second thing here is that if you don't specifically identify these assets, these investments on the P&L, they don't get put on the balance sheet. They're really kind of largely outside of kind of the financial reporting ecosystem, whether that be corporate governance, financial reporting explicitly, and then kind of the auditing process, right? So if there's nothing to audit, it just doesn't go through that process. And then one very kind of tactical issue is the disconnect that you get between internally developed intangibles and intangibles that are purchased through an acquisition. And this is something that on day one is a conflict, but it's something that permeates all the way through the impairment testing process as well. I mean, ultimately, all these things, and there are many more kind of issues that result from this misalignment, but leads to less useful financial statements, less efficient capital markets, and asset allocation. And if we go to the next one, thanks. So one thing to kind of exemplify this need and maybe give a little urgency to it is examining how the pandemic has impacted this issue. So what we did as a preliminary step, we looked at about 500 companies. We did use all US companies just so that we had apples to apples on the accounting side. And what we looked at is we segregated these companies into 24 different industries. And we looked at their price to book value and then looked at how that has changed over the pandemic. The 6 industries on the top are those companies that performed the best during the pandemic from a market value perspective. The 6 at the bottom are those companies that performed the worst from the start of the pandemic until now. And what you can see very clearly is that those companies that rely most heavily on intangible assets of brand, workforce, technology, right? They already had the highest price to book value, the highest misalignment, but they also had the greatest expansion of that price to book multiple as well, meaning that they performed the best and that this problem just got more exacerbated for those companies for which it was already the biggest issue. If you go down to the bottom, 4 of the 6 there have almost no change. Hospitality and leisure and airlines, you do see big bumps. However, this is more of a problem with, or an issue with the book value, taking large impairments and asset write-downs. So this kind of jump is kind of something that if you were to normalize out would also be very nominal as well. And just looking through the list of kind of industries here, these are the tangible heavy type industries, and really seeing that the book value is doing a fairly good job in terms of book to market value. So it's clear that investors want more forward-looking information, and they seem to be saying that they acknowledge that that forward-looking information is less reliable, but they want it anyway, right? And one issue or one area that I personally think that you see this appetite for forward-looking information is really with the rise of ESG. ESG started out with a very much of an environmental focus and a very much of kind of an externalities focus, but in the last year or two has really started to shift to concepts of value creation, long-term value, financial resiliency, right? So in my mind, ESG is trying to kind of fill some of this gap that exists. However, I think a lot of people that have looked into kind of ESG and ESG ratings know that there are some issues associated with it. So what we have here in the table is those same 500 companies. We pulled the ESG ratings for these 6 ratings providers. They all have different kind of rating systems, 1 to 100, 100 to 1, 1 to 8, 10 to 1, AAA to triple C, like debt ratings, right? So you have to get them all on a common language. But once we did that, we looked at the correlations between each of them. And what you see here is some very, very low correlations, a number of correlations in the teens, kind of a clustering in the 30s, with really the highest being 64% and 74%, just indicating that they're all really trying to give the same information about these value creation concepts, but they're obviously saying different things. For comparison's sake, if you do the same analysis with credit ratings, it's in the mid to high 90s in terms of correlation. So it gives you an idea of kind of the infancy that the ESG market rate is, or the ratings market is at this point. So if you keep going, Annie, thanks. So as we kind of move down this process, I mean, the need is there, right? Something needs to be done. And then the question is, well, what are the opportunities? And the key questions we need to answer, I mean, what is the goal here? Is it to get something more akin to kind of an EVA? Is it a check and balance on management and their stewardship of capital for intangible assets? Really defining what the end goal is. What we're going to do is really go through and analyze what intangibles could be subject to kind of additional frameworks? And then what are those investments and those costs that you see on the P&L that correlate to those intangible assets? And then the big question is, I mean, ultimately, what could a framework ultimately look like? Is it around enhanced disclosures? Are there candidates that are better capitalized than expensed? And ultimately, are there kind of value creation concepts, even potentially fair value concepts in certain instances that ultimately would make sense? So our series is a three-part article series. Article 1, as I said, was published earlier this week. Article 2 is really going to go into a deep dive on data analysis and understanding kind of the linkage between the P&L and the balance sheet, and really kind of doing the hard work around trying to see what could be done. And then Article 3 is going to be all about exploring kind of with that data, what could be done, what are the potential frameworks and the roadblocks that we foresee. So with that, I'll wrap up my section, and I think, Annie, we're going to do a quick poll question before we hand it over to Tom. So the poll question we have is, should companies be required to publicly share the value of their homegrown intangibles? Yes, if it's tracked by management already. Yes, even if it's currently tracked, or no. So we'll give people, again, about 15 or 30 seconds to answer this, and hopefully provide Tom with some insights from kind of a user base here.
Thank you very much, Kevin. And just before we end the poll and hand over to Tom, if I could just remind people to please use the Q&A function to ask any questions that you'd like to be addressed in the panel session later.
Annie, I think you can probably go ahead and close it. I'm not seeing the results if they're there. Okay, there we go. So it looks like about 40% say tracked if management does already, about 40% tracked even if they don't do it, and about 20% no. So with that, I'll hand it over to Tom, board member at the IASB, to give an update on what they're doing kind of in this area. So over to you, Tom.
Okay, thank you very much, Kevin, and thank you for having me. It is always a pleasure to participate in an IVSC event. I need to note at the outset that my comments are my own and do not necessarily represent the views of the IASB. So we could just slip forward a slide, please, and another one. During my initial presentation, I'm going to focus solely on what is happening at the IFRS Foundation. However, to the degree that we explore how to improve the reporting of intangibles, the work of brand finance and the initiative outlined by Kevin from the IVSC are likely to prove to be very helpful. The IFRS Foundation has three significant initiatives in which intangibles may play a significant role. First, the IASB is continuing to consider how best to proceed following a review of the responses to its discussion paper, business combinations, disclosures, goodwill, and impairment. Any response to the discussion paper can potentially have a significant impact on intangibles. As well, the IASB is conducting an agenda consultation that will determine which major projects the board will pursue over the next 5-year period. And finally, the IFRS Foundation has decided to develop an international sustainability standards board. We have identified significant support for improvements to the reporting of intangibles across these three initiatives. And in fact, the recent poll is consistent with some of the initial feedback that we've been hearing. So I begin with the responses to the discussion paper on goodwill and intangibles. A significant issue with respect to the accounting for goodwill is whether the board should reintroduce amortization of goodwill with impairment testing or retain an impairment-only approach. The FASB has made a tentative decision to return to an amortization model. A small majority of respondents to our discussion paper favored moving to an amortization model, with user responses approximately evenly split. Those respondents favoring amortization generally wanted the board to investigate whether an economically informative method of amortization can be developed. In contrast, those respondents to FASB favoring amortization generally did not distinguish between economic-based amortization methods versus arbitrary amortization methods. The board is reviewing how best to reach a final decision on this topic. With respect to intangibles, the changes made to the accounting for business acquisitions when IFRS 3 was first issued in 2004 included recognizing at fair value all acquired identifiable assets, including acquired identifiable intangible assets. This led to recognizing many intangible assets that had previously been part of goodwill, including brand names, patents, and customer relationships. Most respondents to the discussion paper supported continuing to recognize separately identifiable intangible assets obtained in a business acquisition. In their view, the separate recognition of identifiable intangibles provides useful information. Should the board decide to amortize goodwill, then it will probably need to reassess the subsequent accounting treatment of indefinite-lived intangible assets that are currently accounted for using an impairment-only approach as well. Although there was no specific question, some respondents volunteered the view that the board should consider a project to improve the reporting for intangibles and for aligning accounting treatments for acquired and internally generated intangible assets to create a level playing field between those entities that grow organically and those entities that grow mainly through acquisitions. Turning to our agenda consultation, consistent with the unsolicited responses to the discussion paper, the initial feedback shows that stakeholders want the board to develop appropriate standards for intangibles. The comment period ends September 27th, so you still have an opportunity to comment. As well, there is a convenient quick survey on the website if you search for something along the lines of IFRS agenda consultation. So I'd encourage you to go there if you're really interested in this topic. There is strong support for selecting the improvement of the reporting for intangibles as a major project in the initial feedback. Such a project might consider issues relating to the identification, recognition, disclosure, and initial and subsequent measurement of intangibles. Any project would also need to engage with a wide variety of stakeholders to identify and consider the types of decisions that better information on intangibles could facilitate, the nature of the information, and how the information can be provided in a cost-effective manner. Finally, we go to the next one, please. The IFRS Foundation will be establishing an international sustainability standards board with a focus on addressing sustainability reporting issues in the context of investor information needs. The board will be formed within the IFRS Foundation, independent of the IASB. However, its structure, governance, and due process will be similar to that of the IASB. Currently, there is a Technical Readiness Working Group, TRWG, establishing a basis for the operation of the new board. Membership in this group includes representation from the Task Force on Climate-Related Financial Disclosures, the Climate Disclosure Standards Board, the World Economic Forum, and the Value Reporting Foundation, which is an amalgamation of the former Sustainability Accounting Standards Board and the International Integrated Reporting Council. So information on the Technical Readiness Working Group can also be found at an IFRS Foundation website. The new board will build on the efforts of existing groups to develop standards that will provide relevant sustainability-related information with an investor focus. It will initially emphasize climate-related information. However, the new board is expected to respond to other sustainability issues in a timely way, including sustainability issues related to intangibles. The foundation expects that on issues where there is overlap, The IASB and ISSB will share information and work collaboratively to develop standards efficiently and to locate the standards where it would be most beneficial. The boards are expected to emphasize connectivity and cohesion in their efforts while minimizing any inconsistencies or conflicts. Where possible, resources will be shared to make the production of standards under each board more efficient with respect to the resources consumed. Ultimately, there should be a suite of related IASB and ISSB standards and guidance that are beneficial to investors and complementary to each other. I'll be happy to answer any questions during the panel discussion, but now I will turn it back.
Okay, hello. So it falls to me to do the final of the 3 presentations before the discussion. We were asked to talk about what the implication is for management and in particular for investors. And the thought that my preparation for this turned to was that generally speaking, we are talking about financial reporting standards in the context of publicly quoted companies, or very often it's in the context of publicly quoted companies. But there's been a huge growth in the number of private equity and venture capital type situations or private ownership structures. And the fact that occurs to me is that where you have those sort of structures, there is almost habitually an annual valuation of some kind of the investments so that the investors understand how their investments are changing from year to year. So in the context of private equity, there is nearly always a fair value exercise done each year to say, well, is the value of the portfolio rising or falling? They are not specifically valuing particular intangibles, but they are putting a valuation on the business as a whole so that the private equity managers can be judged, so the operational managers can be judged, and so that the investors can understand where they are. I think a very similar argument would apply to publicly held companies where there are lots of smaller investors. They have a very similar requirement. So that's my preliminary comment. Let's just go to the world's top 10 most intangible companies. And you can see that very largely they're dominated by the tech companies like Microsoft and so on, where a very, very high proportion of the values are what we would refer to as undisclosed intangibles. Let's go to the next slide. Just as a perfect example of that, if we go and look at Microsoft, you can see that the tangible net assets in their balance sheet represent about 7% of the enterprise value as measured by the stock market. The disclosed intangibles are about 0.4%, and goodwill is 2%. Interestingly, the goodwill is, even at that small level, it absolutely dwarfs the amount of disclosed intangibles. But the thing which dwarfs the whole lot is the undisclosed value expressed by the market. And that undisclosed value is determined by the consensus view of a whole bunch of equity analysts and investors out in the market. And quite often the values are quite erratic, going up and down as facts and information leaking into the public domain come through. So this one chart illustrates 2 problems. The vast majority of value in Microsoft is off the balance sheet. And even within the balance sheet, the intangibles that have been acquired, most of the specific ones are not identified. Let's just go to the next slide. Now, I'm sure most of you will be familiar with this diagram. It is frequently used to explain the composition of a company. And we all know that there are the tangible assets down there in dark blue. They're usually pretty easy to put your finger on and to try and estimate what they're worth. Though, as the Russian example shows, frequently land and building and plant and equipment are not restated to their true value and are often carried above their real value. It just happens that you have a historical number in the balance sheet. And meanwhile, the top categories, which are the ones that we're really interested in and really seem to generate the value, are seldom identified. And I would say, in my experience, if you go and look at any purchase price allocation, the chances of finding much more than a patent or some IPRs, possibly customers and brand, are pretty low. I mean, the number of specifically identified intangibles is extremely low. And the reason for that is the way in which the goodwill treatment allows the residual value in the acquisition just to be plonked into the balance sheet and only impaired as and when. I think we certainly lobbied under the new review that goodwill should be systematically impaired if we're going to continue the way we're going, where you have a specific amortization for the individually identified intangibles. It just creates too much of an incentive to put everything into goodwill if all it is impaired, because frequently impairments can be deferred, as we have seen. Next slide, please. And perhaps an illustration of that is a case that Annie reviewed a couple of years ago when we were showing the way in which goodwill was treated. The write down in goodwill tends to be extremely lumpy, with, let's face it, resistance from management to write down goodwill. They'd rather just leave it there unless absolutely forced to. In 2018, the enterprise value of Thomas Cook was about 3.5 billion US dollars, and the enterprise and the goodwill, I beg your pardon, the residual goodwill was pretty much exactly the same number. That would sort of suggested that there should have been an impairment in 2018. By 2019, the value of the goodwill was just about double the enterprise value, and the company then got into difficulties and was effectively broken up and sold off. Next slide. Fosun came in and were able to buy the brand for £11 million. Now, bear in mind, 98% of the UK population are familiar with and have positive feelings about Thomas Cook. And the brand has been around for like 150 years. And in my opinion, it's very hard to believe, even in insolvency, it was worth as little as this, and on a going concern basis, significantly more. The last date at which we did a valuation of the Thomas Cook brand for our league tables was in 2020, and I think we said that we felt that the brand was probably worth £1 billion. Oh, sorry, I beg your pardon, $1 billion US. And the difference is extremely large. In my opinion, something is wrong with reporting that allowed this situation to arise, and probably the asset was sold at below value. Next slide. Next slide. So the question is, can we boil it down to what should really happen? Like I said in my first remark, this debate has been going backwards and forwards in technical terms for as long as I've been an accountant, and certainly for as long as I've been involved with brand valuation. I remember the first time we ever talked about this was when the debates were going on in the UK for Financial Reporting Standard 10, which I think was back in 1998. And that had actually been prompted as a result of Interbrand putting substantial value on brands in an acquisition involving Rank Hovis McDougall, who were trying to fight off Goodman Fielder Watty of Australia. It resulted in a lot of discussion and the creation of FRS 10, which subsequently led on to IFRS 3. The same debates always come round. It's too technically complicated. There's too much legal risk. There are all sorts of different reasons why it isn't possible. But our view is that management should be, well, we've said here, allowed, but I personally think should be required to provide item 3, some kind of evaluation of the business as a whole, with caveats, but to indicate the value of the business as a whole. And within it, what are the specific intangibles? So that's number 1. Identify the key intangibles of the entire business, both internally and externally generated, in far more detail than you typically get with a PPA, where materiality seems to take hold and the numbers are very small. You usually find that big, sophisticated companies have quite a lot of interlinking intangibles and intellectual property, and it's the whole ecosystem that really creates the value, not just one or two specific ones. And to provide an opinion on the value of those intangibles in the notes to the financial statements. This would be our, I suppose we call it a manifesto, but really we just think it's common sense. Next slide. Now, we know, because we publish 5,000 brand valuations a year based on public information, and we put them out there quite widely, quite a lot of companies do actually already put a note to their accounts and say what they think their brand value is worth, just for the information of their investors and their publics. Many of those valuations originate from brand finance. It always strikes me as a bit of an odd thing that we're able to report the value of brands because we're doing this brand valuation, but the rest of the picture is missing. And I always feel that the dots should be joined and there should be a much greater level of reporting. But to do that, management needs to be involved, probably with external valuation support, perhaps with external valuation opinions, as you get with fair value opinions. But certainly it is not beyond the capability of the valuation sector to be able to do that. And before I finish, I'd just like to refer to one very interesting development that has happened recently. I don't know whether anybody is familiar with the Agenzia Entrada in Italy, but they have been trying to help following the pandemic, Italian businesses to revive themselves. And they came up with the idea of allowing SME companies in Italy to put a value on all of their intangible assets and to put the subsequent valuations, so homegrown intangibles, that is, and to put those homegrown intangibles into their balance sheets. And in order for the full suite of assets that they own to be recognized and perhaps to help them to raise finance with banks and so on. But they went one step further as well. And they said that if the individual company were to pay a charge to Agenzia Entrada, which was about 3% of the value, they would then allow them to amortize those valuations for tax over the following 10 years. And the tax break or the tax benefit to those companies of being able to first value, then set up, and subsequently amortize in their tax accounts is a significant multiple of the 3% that they would have to pay the Agenzia Entrada. So in other words, it's effectively a subsidy to help those companies boost their earnings and recover better. Now, I'm sure that we could have a debate about whether that is really a good or a bad idea. And someone pointed out to me that, well, did they get taxed on the setup of those asset values into the balance sheet? I think it was Tom that pointed that out. Very good point. So that I don't think they're going to be taxed as the values go into their balance sheet. So they're given a free ride. Is it a good thing or is it a bad thing? I think in general, we believe it's a good thing for those values to be set up. The question is, how will we do it to avoid creative accounting and fraud, basically? And so I hope that's a good lead in to our discussion. I think that's my last slide, isn't it? Next slide. Right. So with that, I will kick off the panel discussion. We're almost at the hour, so we're about time to start the 30 minutes. I hope there are questions from the audience. If I may, I'd just like to kick off with one question. I suppose this is directed at Tom, actually. You mentioned what the IFRS Foundation wants, which is on balance, although it's fairly finely balanced, to introduce amortization of goodwill and then to go back and look at the same sort of treatment for indefinite lived specific intangibles. If that were to be introduced, what do you think the behavioral effect would be in the practice of doing PPA valuations and the establishment of values in balance sheets? Do you think it would result in more specific intangibles? Do you think it would most likely result in higher valuations? Would we end up with lower residual goodwill? Or, is that largely a myth? So there's the question, Tom.
Okay, just first of all stress that was more we haven't decided on goodwill amortization yet. So all I said was that if we did that, we have intangibles that are indefinite lived, and the discussion paper didn't raise them. So we would have to think about whether we would apply the same thing to them. So that we're getting kind of quite far away. You're getting quite far beyond where the board is at this time. On a couple of the questions you asked, when I went back to 2004, there was a real effort to try and get better information to investors by pulling the identifiable intangibles outside of goodwill. And you know, and as what you guys have been doing, you know, brands was the significant one. And I know if you're our viewers or our participants, you know, if you go look at any acquisition, you'll see a reasonable chunk of intangibles now that are recognized that if you went and looked from, say, 1995, you wouldn't see them. So that's been successful. We are getting separate recognition of intangibles. I did kind of a mini case study on the Kraft Heinz, which got referenced a lot in the FASB stuff. And they recognized a lot of intangibles. And when they did the write-off, they did make some write-off to goodwill and some to intangibles. So I think the initial feedback we got was we want to continue to look at intangibles and try and separate them from goodwill to the degree that we can. Kind of going forward on the broader thing on the agenda consultation, I think this is where it gets really interesting about what more could we do. So that first part was just about business acquisitions, but I think the more interesting part to you is what will we do with the internally generated intangibles, and what kinds of things might we do? And there is a whole range of things that we can do that we would consider. And again, we're at very early stages. First, we have to get enough feedback that this is what our stakeholders would like us to look at. But there are a lot of things. Even, for example, there's a really good paper by Barker and Penman and some other people, and they just start with thinking about, can we identify the investment in intangibles? Without even thinking about, you know, should you recognize them and capitalize it? And then should you take that to fair value? All those questions will come later, but they have a very nice paper just about investment. So if you just think about all the work that has to be done, I think we'll have a really open mind about what's the best way. Do we start with disclosure? Do we move all the way to recognition? All those questions would have to be answered. And as I said, the kind of work that both the IVSC and you guys are doing can be really helpful in deciding what's possible at any point. But we're about to launch on this adventure, I think.
It's good. It's going to be very exciting for us nerds who like looking at intangible asset values. So can I just ask Kevin, I suppose in a way I'm making an aspersion about valuers when I say that the values are suppressed in balance sheets. Would you like to make a comment on how you think changes in financial reporting might make a difference to the valuation profession?
Yeah, I mean, I think Tom kind of hit, in my mind, what maybe the first step is that then kind of can lead to other steps. And it's kind of the segmentation of the income statement, right? That identification of what is an investment in intangible asset versus what truly is an expense. And just starting, I mean, when you think about what valuation professionals do, that is what we do when we value a company, right? We look at normalized earnings, right? And you see these concepts in non-GAAP measures, which are disclosed by management and analysts alike. What people are trying to do is just that, is to understand kind of what is that kind of normalized earnings and what is investment that is expected to generate value and earnings in the future. So if analysts are doing this, management's doing this, and valuation practitioners are doing this, it seems logical that exploring whether or not that can be done preemptively on the financial statements rather than being done in different ways, in non-GAAP ways by an assortment of other stakeholders, seems to make a lot of sense to me.
So Annie, would you like to comment on your experience of reviewing anomalies with goodwill?
Yeah, I mean, so Thomas Cook that you talked about is one example. We also, in 2018, reviewed the balance sheet of Carillion. And one of the major issues for investors when analysing Carillion was that it looked like they had quite a healthy balance sheet. In actual fact, it was sort of everything was hidden behind this massive goodwill value, which, as you alluded to earlier, David, there is always going to be management resistance to impairing goodwill, because it does two things. One, it's a direct cost against your profit for the year, and so that reduces distributable earnings. And two, it's kind of an admission that things haven't gone to plan, and that acquisition and the integration of that acquired company or those acquired companies hasn't gone as initially planned by management. So there can be major issues as a result of people firstly recognizing too much value as goodwill, and secondly, not necessarily recognizing the specific assets which have been acquired. One assumption and assertion that we make is that if more value is actually attributed to specific identified intangibles on acquisitions, then it's easier for investors to apply some skepticism and know, well, it actually doesn't make sense that those contracts still have that much value because they've lost all of those contracts, or if the value is associated with brands or customer lists and they lose those customers, then it's a lot easier for external judgment on whether those values should be impaired rather than on goodwill. So I think there's a big improvement that could be made even in the intangibles that are currently already recognized. But of course, the major difference for investors in understanding and utilizing intangible values is going to be closing that gap between being able to analyze homegrown as well as acquired intangibles. For looking at the global level, disclosed intangibles are 15 trillion, but it's much larger when you take into account all intangibles, and it's about 60 trillion is undisclosed intangible value. So it's clearly the majority of value. And for management to be able to manage those different intangibles, invest in them sufficiently, and for investors to be able to efficiently allocate their capital, they're going to need to be understood more.
So I remember probably 5 or 6 years ago now, Professor David Tweedy came into Brand Finance and very kindly was talking about his experience of all this. And I remember being quite pleasantly surprised when he said that he had always favored the inclusion of more intangibles in balance sheets. And he actually said that he thought both acquired and internally generated, but that one of the primary problems was a general belief in the quality of valuations that would support them. And we talked about the fact that where it comes to actuaries valuing liabilities of pension funds or surveyors valuing buildings, their valuation methods are deemed to be sufficiently strong to appear in balance sheets and financial statements, whereas the valuations of intangibles are not. And so what I would really like to ask is it's a twofold question. One, do you think, well, all the panelists, but maybe starting with Kevin, do you think that we are getting to a point where intangible valuation practices are going to be considered good enough in the same way that those were, so they're professional enough and reliable enough? Are the qualifications for people doing intangibles good enough? And are they still subject, or are they subject to too much pressure from management, which is why, David was saying they can't go on the balance sheets because they'd have managers leaning on them to creatively account. So it's a question round about this whole area of the quality of valuers. Shall we start with you, Kevin?
Yeah, I mean, I think over the last 15 or 20 years, practice around valuation of intangible assets has grown tremendously. I mean, when you just look at kind of in practice, there's very few conflicts in terms of what methodologies make sense for what assets. I mean, the range of debate really is around kind of small, minute kind of inputs and assumptions at this point in practice, right? So I mean, it really is a fairly mature kind of practice area. And when you kind of look at those assumptions, I mean, they're not dissimilar to assumptions that are made in all other areas of accounting that are non-fair value or non-value related. I mean, there's judgment that goes into many accounting measures that have nothing to do with value as well. So I certainly think that the progress is there to kind of support kind of going further in this direction. And I think like I said in kind of my segment as well, I think the overwhelming feedback that we get from kind of users and investors is that they acknowledge, even if it is a little bit more subjective, that the benefit of that additional information outweighs that at this point, especially just given how intangible dependent so many companies, industries, and economies at this point really are.
So do you think then that the professionalism and training and recognition of valuation of intangibles is at the same level as properties and pension liabilities, and there is absolutely no obstacle as to why these values could go into balance sheet?
I mean, intangibles are inherently always going to have a little bit larger band when it comes to reasonable. I mean, they're by definition oftentimes unique, right? And certain properties can be very like for like. But I think just stepping back, the cost benefit is certainly there when it comes to kind of the level of precision that can be applied for sure.
Okie dokie. I'm looking at the questions that are coming through on my WhatsApp to see who wants to ask questions. One question has come through from Jeff Turner of DSM. He's saying, with the rapidly accelerating drive to shift to a more inclusive stakeholder-based form of capitalism, in which externalities in terms of natural and social capital depletion are internalized, how best can the drive to properly evaluate intangibles facilitate this? Slightly complicated question, but it's really talking about how can you encapsulate sustainability issues, I think, into the reporting of intangibles. Annie, do you have a point of view?
Yeah, I mean, I think this is a really interesting conversation, and it's something that comes up increasingly with our clients, is how can we measure and evaluate the impact of these different topics around CSR and sustainability into looking at how that impacts the business. Obviously, the whole move to internalize some of these areas kind of changes the purpose of what a business is existing for. It goes from being just profit-based to trying to make a good purpose and trying to make a bigger difference on the world. So on the one hand, what that could result in is lower profit because there's different priorities for the business. But in the longer term, I think one thing that intangible assets can do, and in particular brand, is account for how that impacts the way that your company is perceived. And increasingly, it's topics on sustainability and treatment of staff are really important for how consumers and other businesses perceive brands and perceive businesses, which obviously in the longer term is going to help drive more sustainable returns for that business, as we're seeing increasing investor interest in how sustainable and how purposeful companies are. So I think that brand in particular is one area of intangible assets that can account for that and account for that shift in purpose away from just profit to more sustainable issues. And I think that particularly when you're looking at something like the strength of a brand, that's something that you can really quite easily build in and say, what do all these different stakeholders want, and are we delivering against that?
Tom, did you have a point of view about that particular question, or is that outside your scope of reference? Sorry, you're on mute.
Yeah, it's outside I think at present, the board's scope of reference, and again, we have this agenda consultation where we may redefine, and certainly the IASB is going to redefine at the IFRS foundation level. So, but certainly outside my personal one. But I think, you know, there are a lot of people looking at things, and I know in the ESG paper that the IVSC did, they referenced a group who talked about, you know, an intangibles related to the license to operate, which go to, you know, how you treat your employees and how you're perceived and things of that nature, and also liabilities attached to that sort of a thing. So all these things I think are possible. We have to kind of run them to ground and make sure that we can make them. Going back to the prior question, I made kind of just one comment on that. Can we make them hard enough and objective enough that they are genuine information? It's one thing to put something on the balance sheet, but if no one believes it, it doesn't matter. And I noticed even, I think on one of the slides that Kevin put up, his slide 20, when he noted the lack of correlation among the different groups. You know, it said that we don't have, if we had a truly objective measure at this moment, we would have had much stronger correlations. So one of the things we have to work toward, and people like you, David, and your group should be working toward is essentially getting us to a requisite level of objectivity, and with you know, different raters, you know, correlating really highly too. And so, you know,
Yeah.
and that's, maybe I'll just turn the question back to you, is how do we get to that level of objectivity?
Well, one of the things that's going through my mind is that, you know, I did cite the example of properties and of pension funds, but the thought that does actually occur to me is that behind valuing of pension fund liabilities, there are pretty hard tangible assets like stocks and shares and cash and stuff that allow you to, and you know what's being paid to people for salary. So many of the inputs, although the calculation is a bit complex, many of the inputs are pretty definite. And similarly with buildings, you know you own a freehold and you know most of the parameters, and the scope for variation is not quite so wide. One of the issues with intangibles is that the scope for the range in value can be quite wide. So one of the things which is often said is that valuations are done on the basis of going concern. If the company were not a going concern, the value would collapse. And people would put that argument in relation to Thomas Cook, for example, say, you know, without a going concern business, Thomas Cook brand name is not worth a thing. And one of the things I feel is when we do brand valuations, you sometimes find yourself valuing a brand where you know almost categorically that if the current incumbent went bust, someone else would pick that brand up and run it in a similar business and probably make it worth almost as much, or just as much as it was for the incumbent. And others you look at, it does require that their business is a going concern. So I think what that's about is much broader levels of disclosure and sensitivity in the notes to an intangible valuation if it's going to be disclosed in the balance sheet. And this then gets us on to the perennial reason why management don't want to do this stuff, because they say, well, the more disclosure you give away, the more possibility, you know, sensitivities and possibilities, the more fundamental commercial information you are giving away. So I suppose, could I ask that question? Do you think the reluctance to give away confidential information is going to be the nail that means, you know, in the coffin, that we will never really get intangibles reported because it gives away too much information? Or do you think that it is possible?
Is that addressed to me?
Well, to all three, but you can start, Tom.
Okay, I'll start then. It's interesting because in the discussion paper, which was about business combinations, and we advocated some much better disclosures about the performance of the acquisition. And there was a lot of pushback on exactly, well, two things. Would it be forward-looking? And two, would it be commercially sensitive? And this was simply to get some metrics about, you know, why did you pay what you did? And are you sort of achieving the goals that were necessary to justify that price? So there was certainly a lot of concern over that. So I think that would be, I don't think it would be a nail, but I think it would need to be something that has to be thought about very carefully with respect to if we were to, do brand value, bring in internally generated brand values in some place. And again, the other thing we need to think about is just kind of like the way they did with options is it's sometimes easier to start with a note than to start with full-fledged recognition. But I think it would be great if people working on that thought about the degree to which this commercially sensitive and forward-looking both issues will arise. Are they really deadly? How can we get around them? How can we provide the information that people would like to have without, tripping over these two things? So that's something that we have to look at as we get in. And again, I'm going to stress that the board's at early stages, as is the sustainability board. So we remain open and optimistic. And the fact that we put out that thing on business combination suggests that we're certainly willing to look at better information for users.
Annie, do you want to make a comment here?
Yeah, I mean, I don't think it's impossible. I don't think it's a nail in the coffin. I think it is, as Tom says, something that definitely has to be navigated. Presumably, there was a time where lots of other things that are sort of accepted as things that you have to disclose now, we're also worried that would be commercially sensitive. So I think it's a bit of a mental block that we need to get past. There are, of course, corporate governance rules that make people quite wary of sharing information that could be deemed forward-looking. But I think practitioners can partly get around that, and management can partly get around that by caveating everything with the assumptions used and sensitivities and quite transparent methodologies on how valuations are reached. And I don't see there being so much information required that would make it commercially sensitive, particularly in the valuations that we conduct. They utilize some information which comes from management and may be deemed commercially sensitive, but for the most part, the results themselves are giving just separate information that management probably don't actually already have. So I think there'd be two benefits of better disclosure of intangible assets. One, it's providing information to investors, and two, it's making sure that management are actually tracking that themselves. And I think there could be a route forwards where it's new information that's being created, which is being shared, rather than sharing information which is confidential and commercially sensitive.
And Kevin, what do you think?
Yeah, no, I'll jump on with what Annie kind of started off there a little bit, but I mean, everything in the financial statements currently is commercially sensitive, right? How much you pay your employees, what your margins are, what your revenue is, everything's commercially sensitive. It's just a matter of, I guess, degree, and does the benefit kind of outweigh any kind of sensitivity? The commercially sensitive nature of information is what makes it relevant to investors and stakeholders, right? So it certainly acknowledge that there is commercial sensitivity, but does that outweigh the benefits of the capital markets at large to provide more information about the commercial operations? I think that's the question, and that's the cost benefit that needs to be addressed.
The rubber hits the road when you get into specifics. And yesterday I was doing a similar conference to this, but with German lawyers, which was quite interesting, trademark lawyers, and we were talking about the fact that brand valuations are supposed to begin with an extremely detailed inventory and analysis of the strength of trademarks, both in classes of business and in geographic territories. So you work out what they are, and then you put a value against those areas and make sure that your valuation is consistent with them. And over the years, we have actually seen valuations where we're being asked to put a value on brands that are not registered in a territory or in a class. And you go, well, I can't do that. There's no value there. The thing is, once you start disclosing all that detailed information about where brands are registered and what they're registered for, you're kind of almost inviting someone to put a blocker in there. Or if, for example, you take a look at some patents patents, whether they're pharmaceutical or other kinds of patents, companies very often invent patents to do a particular thing. And then somewhere in the background, they suddenly work out, well, it could be used for something else. And I can understand why people would not want to be disclosing. Or you can say, well, it's worth a lot of money because we can now move it into this new category, but we haven't yet done so. And so I do actually get why people are more sensitive than, for example, they would be about a building valuation or a pension valuation. But I agree with you. I think I'm agreeing with everyone that there has to be a way of pursuing the narrative to give more information, to put greater flesh on the bones so people can understand. Because many companies you really don't understand, and often they are taken over at a snip, because nothing's in the balance sheet and nobody really understands. I think that is the problem. So can I ask another question? I mean, we've talked around this issue. If you were a betting person, when do you think we are going to see internally generated intangibles and brands regularly appearing in balance sheets because they are required to appear there? Certainly this debate started in 1988 and it hasn't yet been resolved for brands at least. So do you think it'll ever happen? And if so, when? Starting with Tom.
It's a bit tricky. I would say yes, but I would start with as I said, I think if we start with the notes, I think you need to advance on all fronts, and so getting him into the financial statements would be my first goal. And at the end, if we had everything down and you'd worked out all your valuation stuff, David, and it's had a big influence on what we did. At the end, we can make a final decision whether it's just a note disclosure initially or whether it's a recognition thing. That's not the heavy lifting. The heavy lifting is, even to get in the notes, we still need to get to a reasonable level of confidence and objectivity and auditability and all those sorts of things. And so that it would make, also we'd have to demonstrate it makes a difference to investors for at least some decisions. And then I think, yeah, because for all the reasons, the interest in your organization and the interest, as Kevin said, with the IVSC and them doing something, and the interest we're getting, that everyone seems to think that better information in this area is required. I think we'll get there. We need to work together, and I think we need to, there's that old phrase, don't let perfection or something be the enemy of the good or something. I think if we need to work, though, to get something initial that is pragmatic and works, and maybe just get it in the notes as opposed to all the way in. And one possibility, with some of the labs that are being created, like the FRC, is could you get some organizations to take some of this stuff and test it, and if necessary, go to a regulator and get, you've got protection from being sued or something if you do this lab study if you got, say, half a dozen firms, just to get going, and then to really take a hard look at the kind of measurements, the kind of information you need. How do you actually make this happen in reality? Because it's a lot. It's going to be a lot of work to get all the pieces in play, and so I think we need to just really be cognizant of how much work it will be, but then get to work.
So, Kevin, did you want to say anything else before we hand over to Zoe to wind the proceedings up?
I don't know when and what exactly it looks like, but I mean, I am encouraged that progress is being made in this area. And I mean, I tend to agree with Tom that it's going to be small steps and it's going to be a long time. And whether that's disclosures or notes, maybe examining the income statement and starting to bifurcate expenses in a little bit more detail. I think those small changes have a good probability of happening. And then kind of where it goes from there is really anyone's guess. But I am definitely encouraged by kind of what's going on and the discussions that are being had by really kind of all the stakeholders in this ecosystem.
Well, the magic number seems to be 2050. So the date by which we're all supposed to be carbon neutral is 2050, according to COP26, whatever it is. And perhaps by 2050, we will have full disclosure on intangibles. I certainly hope we move towards that. Between now and then, there will be significant changes towards legislation of the way this information is disclosed. Because I do think there is significant opportunity for misleading investors if it's not very tightly controlled. And from our point of view, I think what that means is our business is likely to be much more heavily professionalized and regulated in order to avoid those things happening. And I personally think that there will have to be quite significant controls over what boards of directors are allowed to do and say for the valuers who put the numbers into the accounts, because there's a lot at stake if the numbers are misreported. Anyway, that's just my view, and I've really enjoyed this chat. Been great. I'm now going to hand to Zoe. I think we've got one last question, and she's going to wrap up the proceedings. So thank you very much to all of our panelists, and thank you for everyone for listening so far.
Thank you very much, David. And I believe we have time. We wanted to include one more poll question for our audience this afternoon. We had a question: how well understood do you think intangibles are at your organization? Very well and tracked regularly, basic understanding, or no understanding? Just give you a couple of moments to have I think a response to that, and just regarding closing comments, and thank you so much to all of our speakers for the very insightful presentations and interesting discussion this afternoon. I think we all agree we could have probably gone on for another half an hour or so, but I understand we have to wrap up. I posted the download link to the GIFT 2021 report in the webinar chat, but for reference, a link to access all our reports is branddirectory.com, where you can access the GIFT report there too. Our webinars are online, available to view online on the Brand Finance YouTube channel, and this webinar recording will also be circulated to all registered delegates tomorrow afternoon. And I would also like to take this opportunity to invite you all to join us online for our next event on the 30th of September, where we will be hosting a special 25th anniversary edition of the Brand Finance Global Forum. I've also posted the link in the webinar chat. And if you would like any further information about the topic discussed today, or how to register for upcoming webinars, please email events@brandfinance.com. Now, Annie, I believe we're just about ready to finalise the poll.
Yeah, still a couple of people voting. There we go. Okay. So the majority of you say basic understanding of your organisations, and I think the results of this poll are actually quite promising, along with the conversations that we've been having and the engagement that we're seeing from stakeholders across the board on intangible assets. Promising in that a lot of you are saying that you think intangibles are very well monitored already at your organisations and tracked regularly. For those of you who think it's just a basic understanding or no understanding at all, obviously get in touch with Brand Finance. We'd be more than happy to help. But hopefully the webinar today has provided you with some information and some materials to help you in understanding and managing your intangibles more in the future. So do get in touch if you have any questions that we can help with. And yeah, again, echoing Zoe's sentiment, thank you very much, everyone, for joining, and to our guest speakers today.
Lovely. Thank you very much, and we hope to see you all again soon. Thank you. Thanks, Tom, Kevin, David, Annie. Hopefully see you all at our next event. Thank you.